Good afternoon. Welcome to the Jack and Bill Show. A little different setup today. You've got Bill, and we are live from the Bill Cave. I'm actually sitting across from my partner in crime here, Wesley. So he is within arm reach. So if I get myself in trouble, I might get punched. Hey, it's been an interesting week in the markets. Looks like the stock market trended a little bit down this week. The big news was the Fed, the Federal Open Market Committee meeting this week. All eyes were on the Fed and Chairman Jerome Powell. Would he be dovish? Would he be hawkish? Would he spark a Santa rally through the end of the year? Or would we end up with a taper tantrum and a sell-off in the markets? Well, this is what he did say. He has officially retired the transitory inflation narrative. He even admitted that was a mistake on his part. The Fed announced that there would be a faster wind down of emergency quantitative easing bond purchases. In fact, the pace will be doubling of the wind down. And he signaled that there would be expected 3 1/4 point rate hikes next year. And then lastly, and perhaps most importantly, he took a hawkish tone in addressing inflation risks. Inflation, yes, inflation. Everyone's tired of inflation. Perhaps part of the reason is because it is so narrative driven. And we do know that inflation can be a self-fulfilling prophecy. The more we talk about inflation, businesses may feel more justified in raising prices, and consumers may feel justified in changing their buying habits. The other reason is that inflation can be politically motivated. And as we're seeing in today's environment, it's the party out of power that's talking up inflation the most because it's in their interest to make consumers and Americans concerned. So, what is inflation? Well, the definition of inflation is the decrease in purchasing power of money reflected in a rise in the general price level of goods and services. And I watched an interesting debate this week between a couple of very, very smart individuals discussing inflation, and they got into the weeds on the topic of what is the right type of inflation, as if there's a wrong type of inflation. And it got me scratching my head a little bit, and I'm thinking, wow, this is a lot of academic gobbledygook. I mean, everyone knows that prices on things like gasoline and food and autos and appliances, et cetera, are increasing. That's inflation. The prices are rising. But it made me think as well, what about things that are outside of the control of our monetary authority, the Federal Reserve Bank? Like, for example, energy. Crude oil is priced internationally. It's traded in international markets. These issues that we're seeing with imported goods, especially coming from China, and the supply chain disruptions, that's another example of something that's outside of the control of the Federal Reserve Bank. So what happens if we see a decline in oil prices? Or what happens when we see supply chain bottlenecks cleared out? And eventually they will be. What does that mean for inflation? The other thing is that we're not seeing the costs of services, which are priced domestically, following the rise in the increases in costs of imported goods. So what causes inflation? Well, there's 3 broad categories of things that cause inflation. One of them is government spending. So when we're in an environment where the federal government is spending to stimulate economic activity, that's a big one. And we've had some of that for sure. A second one is real economic growth. And that's just simply where demand is exceeding supply. Well, we see that right now. There's more demand for autos and appliances than we have supply. And we know the reason for that is because of supply chain disruptions. The third one is monetary policy. And we can go back to Fed Chair Alan Greenspan. Back in the year 2000, Greenspan said that inflation has to be a monetary phenomenon. Well, he went on to say that a decision to base policy on measures of money presupposes that we can locate money. And that has been an increasingly dubious proposition. What he was alluding to is that the Fed really has less control over money than we give them credit for because of innovation that we've seen in financial markets. So perhaps we're giving the Fed too much credit. I mean, look, when we're talking about the Fed tapering monetary stimulus, ending quantitative easing bond purchases, raising short-term interest rates, that is expectedly a tightening for financial markets. So we would expect to see financial markets respond to that negatively. But how does that impact supply chain bottlenecks? What good does the Fed tightening financial markets or tightening monetary policy, what does that have to do with supply chain bottlenecks? Or what would that have to do with lowering the cost of gasoline at the pump? It has nothing to do with it. So again, I think we're giving the Fed a little too much credit here. And I think back to when the Fed embarked on all of the monetary policy stimulus post-credit crisis. Well, did we see those actions stimulate underlying economic growth? No. Did we see those actions cause inflation? No. So we were tracking at about 2% average inflation. We couldn't get above 2% inflation until recently. So what is the bond market telling us in the midst of all of this? We're seeing the opposite of what you would think. If the bond market is that concerned about inflation, then why are we seeing long-term bond yields fall? Why are we seeing yield curves flatten? What? Yes, the bond market is actually signaling to us that even with the federal government curtailing bond purchases, that someone will come in there and fill the void and buy government bonds. We ask this question a lot. Why would anyone buy a 30-year U.S. Treasury bond yielding right now 1.8%? That means you will earn 1.8% nominally for 30 years. Why would anyone do that? Well, they're doing that to hedge market risk. It's like buying a put option on the stock market. So apparently the bond market does not agree with the Fed's assessment. The bond market could actually be sniffing out recession. Well, what's the stock market signaling? We have been seeing sell-offs in speculative investments like meme stocks and cryptos. We have been seeing some recent weakness in momentum and cyclical factors. We've also seen the opposite in factors such as low vol and quality. They've been going up. And one of the sectors that's been doing surprisingly well has been utilities. So both the bond market and the stock market seem to be signaling very different things than the Fed. The other thing that I would point out is that we're not seeing very good breadth in the market. For example, we have been like the NASDAQ. The NASDAQ Composite Index is near its all-time high, but only 35% of the NASDAQ component companies are trading above their 200-day moving average. So basically, you've got about 5 to 7 names in the NASDAQ Composite driving all the returns. So it's a sign of very weak market breadth. The leaders, the big mega cap, large cap tech names are leading, but where are the troops? So that is something we need to be paying attention to. So I'll summarize it like this. The markets did not blow up this week. The markets did actually move up on the day of the FOMC announcements. Jerome Powell, he proved himself neither an elf or a Grinch, and the market seemed okay with it. I'm calling Powell an elf, but I say let's put this elf on the shelf where it belongs. We're giving the Fed way too much credit here. So have a great weekend. Have a very Merry Christmas next week, and we will see you back the week after next. Cheers.